Okay, we're good to go.
Go
How
ahead.
are you doing today, Uriel?
Great. It's a pleasure to be here.
Awesome.
How you?
So
How are
today,
you today?
awesome, amazing. So today is our 11th episode. We're gonna dive deep into bonds, investments, family offices, and so on. So it's gonna be exciting conversation to have. So as our beloved tradition, I want to ask you, what is your story? Like, what drew you to family offices, to investments, to the financial markets? Why?
So first of all, I just told you that I'm doing great. So it's all
Yeah.
under the special circumstances in Israel and the low moral of the Israeli people. So we call for peace, and all the hostages will be back home.
Yeah,
Let's start with that. And
for sure.
after we say all of that, yeah, I would like to start by introducing myself and the
Sure.
company. So my name is Uriel Zilberman. I'm a married father of three from Israel with nearly 15 years of experience in investment management. My career has spanned roles such as a proprietary trader. Actually, I started as a bonds proprietary trader.
Only
Then,
bonds? So you
uh,
started with only bonds and then
especially, I started just in a domestic investment grade bonds, and then after a little bit global fixed income.
okay.
Then as a pension fund manager. After that, a mutual fund manager, and now as a portfolio manager within a family office. So for now, I currently serve as the investment manager and portfolio manager at Alphen Asset Management. It's a Swiss-based investment management firm under the Shine Group, under the umbrella of the Shine Group, actually. The Shine Group established over 35 years ago in London by Michael Shine. God bless him. It's now led by his children. The group offers comprehensive suite of services, including family office and international and local law firm, Swiss asset management company, which regulated by FINMA. This is Alphen Asset Management, and a Swiss trust company. Our clients, our families, have been with us for several decades, and we provide them with a wide range of services, including legal investments and tax investments. Some of them with us from the start of the company, actually 35 years ago.
Well, they
So
got
yeah,
they
yeah,
got
yeah,
everything they need.
yeah. So let's dive into the art of the matter,
Exactly.
investment. Yeah.
Sure. So navigating global markets with bonds, given your extensive experience in managing portfolios within a family office, how do you approach bond allocation in a global market? Can you share specific strategies that you employ uh, to balance risk and return, especially in today's volatile environment?
So it's a great question to start with. Building an investment portfolio within a family of it is very complex, especially in today's volatile market, as we saw yesterday,
Yeah.
especially as we saw yesterday. When building a portfolio, we need to get to know our clients inside and outside, actually from up to bottom, in order to tailor the best suit for them. We
What do you mean
start
by that?
yeah, we start with the basics: age, needs, income, personality. Then we assess their entire financial picture. I give you an example. A billionaire with a real estate portfolio and a steady monthly income has different needs than someone who just made his exit and got the same billions, and he just want a passive income from his portfolio. So,
So he wants
so
quietness. Like just passive income, normal income.
Yeah,
Just
yeah. It's
to
from
get
up,
assured that
so
it will come to him, not just like
yeah,
startup that just could be gone like in a year or two
he
because the
just he
risk
just
is
lives
higher.
he just live on the cash flow from his portfolio.
Okay.
So it's the app. We are dive into the bottom, and it's the risk tolerance. A client with a huge exposure to investments in startups might be comfortable with high risk, while someone needing a regular income might prefer a more conservative approach. To manage all of this, all the risk, I carefully consider the duration of the bonds and the issuers I select. I also consider the coupon rate. For the cash flow, as I said before, sometimes a bond with a slightly lower yield but higher coupon might be a better fit for my client for his specific needs.
But there is a fine line uh between high risk and low risk. Um, how when managing a family office's investments, how do you decide between corporate or government bonds? Depends on depending on the risk appetite for for
So
investor.
I get what you mean. Generally, my belief is that a well-managed bond portfolio should primarily consist of corporate ones. Clients pay us management fee and pick us to generate better returns and alpha for their portfolio. Our job is to assess risk and find the best investment for them. That's my approach. However, especially in those volatile days, as I told you, as we saw yesterday night,
Yeah.
there are always exceptions. I use government bonds like T-bills as an alternative to traditional deposits or cash management. When I see a good opportunity in a bond with a specific duration, like nice opportunities to trade on the curve, I might buy it and take on a higher duration risk because there is no issue risk. And the liquidity, by the way, it's much better. I also actively seek out government bonds from countries other than the US. For example, during the recent war in Israel, Israeli government bonds were yielding around 6.5%. The supply of Israeli corporate bonds in dollars was very low, with many being issued by banks, tier one and tier two bonds, and energy companies with extremely exposure to the risk of the Lebanese attack.
Okay. So
I,
dive deeper. Just explain what is tier one and tier two bonds, just for the audience to know it.
can you repeat?
Can you explain what is a tier one and tier two bonds?
Yeah.
Just to
Uh,
clarify.
yeah. Uh, tier one and tier two bonds, it's layers of the bank's debt. Okay, there is
Okay.
a senior, subordinated, in the middle, which is the tier two, and tier one. Okay, it's a layer of the bank's debt and equity. Okay, and there is a you can buy the specific layer and be exposed to. Okay.
Yeah.
I just want to extract a little bit about the Israeli
Sure.
bonds, uh, about the banks and the energy bonds. I didn't expect the credit spread to narrow because of the Lebanese risk. So I saw the Israel bonds as the best option. Uh, so to sum up this question, well, I believe that government bonds can be used tactically or for client-specific requests, I truly believe that the typical family office portfolio should primarily consist of corporate bonds. This is the answer for your question.
Okay. And what key indicators or trends do you monitor to make those decisions? Like every trend, you try to analyze every trend coming or globally or just domestically trends.
No, actually, it's the best. It depends of the volatility, the time, the client's appetite for risk. It depends on a lot of stuff, actually. I can't give you a specific
It's
answer.
too much. Yeah.
Yeah.
So regarding asset allocation, how do you bonds fit into overall asset allocation strategy at Shine Global Family? And do you see a trend towards increase or decrease in bond exposure in the coming years?
Okay, so with the rising interest rates and increased volatility in stock market, there's been a growing interest in bond investments. In previous years, portfolio tended to lean more toward stocks, alternative investments, real estate, thanks to years of near zero interest rates and flat curve. But as rates started to rising, we saw a shifting away from all those asset classes and search toward cash and fixed income funds. Now, with the understanding that interest rates won't stay high forever, there is a massive flow of money into corporate bonds. We've seen this trend firsthand, and fortunately, we were ahead of the curve in this trend. When building our portfolio, we focus on selecting specific bonds rather than relying solely on funds and indexes. We are a China group where we truly believe that active portfolio of uh, active bond management offers a significant advantage, allowing us to build the right portfolio and capitalize the market trends.
It
We
is
anticipate
it has a more advantage because it's stable. Like more than real estate, more than other asset classes, it is stable. Like, this is the
it depends on how the client sees this. Like there are clients that more likely to have some small apartment in the, I don't know, in a small town, rather to hold the U.S. Treasury because he sees the P&L each day and each moment. Okay, so it really depends of the client appetite. Uh, so to about your question, we are anticipating rising rates, identified opportunities when yields were at their peak, and navigating the uncertainty surrounding the potential rate cuts. And now, as we are on the brink of rate cut cycle, God bless the Fed. The conversation is shifting towards the pace of the cuts.
yeah.
So, from my opinion, this is the time for high and strong investment grade with a long-term corporate bonds, and to be more specific, specified, for issuer with a strong cash flow.
Okay. So, as a portfolio manager who deals with mutual funds, how do you incorporate bonds into those funds? What are the challenges and opportunities you face when integrating bonds into mutual fund portfolios, particularly in the context of a family office?
Okay, so as I described my CV when we just start,
It's not exactly a CV. It's just formally, though.
Short CV, yeah. I used to be a mutual fund manager for 7 years. So I can offer some honest insight into the differences
Go ahead.
between bond ETFs or actively mutual funds, industry, and tailor-made actively management portfolios. So while ETFs can be great for managing stock portfolios, they have a significant drawbacks when it comes to bonds. Unlike stocks, where the methodology often reflect the investors' preferences and the company's quality, bonds indexes have their limitations. For example, bond ETFs often have higher duration, all securities based on their size, and may underperform the benchmark due to size and liquidity constraints. Additionally, they might not distribute coupons, and investors may miss out on the benefits of bonds roll down. Investing in a bond ETFs is essentially like betting. I don't know if betting is the right description.
Betting? Really?
It's a pure position. It's a pure position of declining yields and narrowing spreads. It's a pure macro position. Yeah, yeah. And about mutual funds, by the way, it's require much more analysis. Investors need to understand the fund's prospectus and be aware of actually two key issues: competition and agent problem. So competition can lead fund manager to focus on underperforming their peers rather than maximizing return for clients. It's the
You
first issue.
specifically mentioning ETFs, right?
No, mutual funds.
Mutual funds. Okay.
Yeah. The competition is much more aggressive in the mutual fund industry. And the agency problems arise when smaller funds takes an excessive risk to stand out, as their survival may depend on it. For Alphen, by the way, we use ETFs mainly for very small portfolios, or when direct management isn't possible due to a minimum investment requirement. The minimum for most of the bonds is like $2,000 for each one.
2000.
Yeah. We prefer targeting bullet ETFs or special mutual funds. And we also use AMC product, which I guess that most of our listeners heard about this product. It's allow us to implement our model portfolio and strategy into a like mutual fund, actually, offering investment the benefits of scale, lower cost, and the tax deferral.
Okay. So, regarding interest rates, do they have significant impact on bond performance? How do you manage bond portfolios in response to changing interest rates? And what strategies do you use to protect the family office's investments during periods of rate hikes or cuts, like in this period that we are
Yeah. I got
that
what
we
you
have
say.
right now?
Yeah. In general, the duration of our family office portfolios is relatively long because we build them for with a long-term horizon, sometimes or for a retirement or as part of estate planning. However, we also need to consider appropriate returns and cash flow, especially for client savings for retirement. During periods of low interest rates and the flat yield curve, we reduced our bond exposure and allocated more to alternative investments. Conversely, during periods of rising interest rates with a negative yield curve, we shortened the duration of our portfolio and shifted toward floating rate bonds. But today, as we all know, especially given the market underestimation for rate cut cycle, from my opinion, until a few weeks ago, when the 10 years was above 4.2, and a few months ago it touched the 5% actually. We've extended the duration of our portfolio and locked in interest rates and coupons for 10 to 15 years and sometimes even more. As I mentioned earlier, our guiding principle are the client-specific needs and the investment opportunities in the markets.
You said also alternative investments. So, what are the most you, when you say alternative investments, what do you mean? Like, what exactly? Real estate, mutual funds? Could it be what
Mutual fund
goes
is a
into
suit.
alternative investments?
Mutual fund is a suit. It's not the alternative. But
Okay,
yes, real estate, REIT funds.
REIT funds.
Yeah, yeah, it's a nice example actually.
So
Structured
you
products
allocate.
sometimes.
So based on the investor needs, you allocate what is needed to be in the real estate, and so on and so forth. So you have to suit. You can't go to high when the market is volatile. You can't go to high risk if the investor doesn't want that.
Yeah, yeah, yeah.
You have to
Actually,
specifically, surgically pick the uh, pick the investments that you're gonna do and make them.
yeah, yeah, yeah.
Got it. Okay.
It's a huge weight of consideration behind a
And
decision
you have
that we
infinite
make.
opportunities. I mean, you cannot stuck into trying to find some opportunities and try to analyze each one of them, but you have to just pick one and go with it, right?
Yeah,
By the way, how do you stop when you have such a lot of opportunities? How do you pick one and stop there? Like because if you see another opportunity, you might go, okay, well, there's a better opportunity, but if you go to that opportunity, you might find another one. When do you decide to stop? Because it's
now, first of all, due diligence.
okay.
The second thing is I should believe in the investment manager. I give you an example, and I will not specify the name. There is a professional, a nice mutual fund company that I'm investing. Okay, I'm invested especially in their pharmaceutical mutual fund. As you see, there are any a guy with PhD behind me.
Yeah.
So they probably do better than me. So I want to pay them to get their professionalism and the great returns. And as I say before, the macro environment is supporting this industry right now.
Okay.
So when I
Great.
consider all of that and visit them in London and talk for hours within the investment manager, yes, I pick and I believe this is the best investment and opportunity for my client.
Got it. So you don't go to another opportunity, just pick one and stick with it.
Yeah.
Got it. So regarding bonds, bonds are often considered a safer investment. So for wealth preservation, how do you ensure that bond strategies you employ are aligned with the long-term goals of a family office, and particularly in preserving wealth for future generations?
Oh, so it's the big question of the family office, actually.
It's always the
Uh,
question.
yeah. When selecting companies, we focus on those with stable and consistent cash flows, both from the company itself and the industry it operates. We also include perpetual bonds with fixed income bonds from stable banks in our portfolio. And if I goes back to your, not the previous, the one before of the bank's debt structure, so investing in banks debt structure requires a high degree of specialism and professionalism. There are many opportunities, but also enormous risks that are not sufficiently appreciated in the market, as we have seen in the cases of Credit Suisse and Silicon Valley banks. So this provides a stable and secure investment with a strong cash flow over the long term. When we are making individual selection, we look for bonds where the issuer has less incentive to earlier redemption, which we are not be surprised, such as those where earlier redemption might impact their capital recognition, or where where the coupon reset isn't too high. Most importantly, we always seek to invest in bonds from companies that are fundamentally bond-like and boring, with stable growing cash flow and supportive business environments. Bonds, as you know, as a maturity date, even perpetual bonds can be redeemed by the issuer. That's why I mentioned earlier that the duration of our family office portfolio tends to be longer, especially in high rates curve, as we have now.
Yeah. And you pick, well, and it's all based upon experience, right? So you don't necessarily explore new strategies to preserve the wealth, for future generation. You just stick to the what is based upon experience
Yeah,
because it's the
yeah,
best choice.
yeah, yeah, yeah. I agree with you.
Yeah.
Yeah.
And so the bond, as we know, the bond market has seen various inventions in recent years, from green bonds to digital bonds. How do you see those inventions affecting family offices strategies? And are there any new bond products that you are particularly excited about?
Okay, so for generally, the bond market is essentially a black box for the general
True.
public. Yeah, it's not accessible, transparent, and understandable, actually. Israel is a pioneer in this area with electronic trading and the standard prospectuses.
Actually, what do you
Oh,
think about it? Just what do you think about like that is not transparent? You think
uh,
that it should be?
for 100%.
Yeah.
For 100%, yeah. Uh, so as I say, Israel
Yeah.
is a pioneer in this industry. However, in other markets, the trading process is significantly different, which is why people are drawn to ETF and mutual funds. The broader public with less capital is missing out on opportunities, and their money is flowing into investment firms, brokerages, and clearinghouses. I truly believe that trading needs to become fully electronic and accessible to the public. This will increase liquidity and facilitate the debt issuance by the company. If regulations continue to interfere rather than protect the investors, I predict a shift toward digital bonds. Currently, regulation is like, I give an example, a regulation is like telling people not to drive a car when they should be providing their safety features. The public will eventually adopt the technology without those safeguards. Regulations can be beneficial when used for the public's goods, as in the stock market, by the way. So as a family office dealing with qualified clients, personally, we are benefit from the current inefficiencies in the market. Our trading is more or less like, it's similar actually to electronic trading, allowing us to find attractive opportunities for our clients. However, ideally, the market should be more transparent and accessible. And you specify trends, right? Digital bonds and green bonds.
Yeah.
So regarding those trends, I think that they are just trends. Ultimately, everything reflects in investment. For example, you specify a green bond, I will
Yeah.
specify renewable energy, okay? So while I'm personally committed to environmental causes in my personal life, I don't invest in this company solely for that reason. I assess them rationally, considering the environmental and economic needs. Today, there are fantastic companies building solar farms with impressive cash flow. I will specify another example, ESG score. So I so as I told you about the renewable energy, I don't evaluate a company based on this ESG score. I go into the report to assess its corporate governance, environmental, and social practices. A company with a strong ESG practices often demonstrates good management, a broader perspective, and a better performance. And you also ask about
About the other any new bonds products.
if I like trends.
Yeah. Also.
Some other trends. So as I told you, I'm a big fan of the AMC structures, which is gaining popularity and allow for efficient portfolio management. They offer clients the benefit of scale, lower cost, and access to a wider range of investments with relative low capital requirements. This is a huge growing trend in Europe. Most of the big banks providing this product. And I also appreciate structured products like AMC, by the way, it's a structured product. So unlike AMC, I also like coupon products as a short-term alternative to bonds. With a proper management and risk, I think this can provide excess returns for clients.
The final question. I want to ask you why bonds are not that transparent. Do you have any opinion about it? Like why they're not transparent as stocks, as any asset, any other asset?
Uh, I think
What
it will be. It's
it
the
will be.
future. Yeah, you cannot run away from that.
But what
From
what
that,
will change?
uh, easing the regulation, uh, governments, uh, fear from electronic trading that will take the profit from the brokerages and the asset management company. I think in the future
You you think
we are
that
going to be there. Yeah,
you
I'm
think
fully
that
believe.
it's possible to take like, you think that algo not specific algo trading but algo well it is algo trading. You think algo trading will actually take
What you mean
like
by
the
like
profits from
they're
the
going to be market makers?
not exactly no you said electronic trading right so that will take the money from the brokerages and so on and so forth. It might happen like
Uh, you can
well I mean theoretically it can.
you can look at the big to Bitcoin and blockchain industry. Uh, it's a world that it came from our world because of our the FX trading is handling. It comes as an alternative, and I'm sure that if it won't happen at the best regulated option, like it should be for the bond market, it will go all the way like it happened with the FX.
Yeah, they actually might. What do you think about crypto? Just say, do you have any asset allocation to crypto, or like you don't touch? You don't touch it, okay?
No, I don't believe it's not
Don't believe.
it's not a product that I can analyze. I think, from my opinion, it's a pure bet. But
No, actually,
I
it
was
is.
told
I mean, it is with the
I
volatility.
was I can tell you the same 10 years ago, and if you were thinking the opposite, you were making a lot of money, much more than me. But
Yeah, yeah. Okay. Thank you, Uriel. It was a pleasure. It was a pleasure to have
so
you here.
just to sum up,
Yeah,
the foregoing does not
yeah,
constitute or replace investment advice and should not be relied upon.
for sure.
Yeah.
Thank you, Uriel. It was a pleasure.
Thank you very
Really.
much. Thank you for asking me. Thanks.
Thank you. Okay. Bye bye.
Bye bye.